Well, good morning, Yaginder Rana here. Topic for our discussion today is planning investment portfolio. Planning investment portfolio. Investment is the employment of funds with the aim of achieving additional income or growth in value. It is allocation of monetary resources to assets that are expected to yield some gain or positive return over a given period of time. These assets range from safe investments to risky investments. So, investment is a commitment of a person's fund to derive future income in the form of interest, dividends, rents, premiums, pension benefits, or the appreciation of the value of their principal capital. The investment has two attributes, namely time and risk. Present consumption is sacrificed to get a return in future. The sacrifice is certain, but the return in future may be uncertain. This nature of investment indicates the risk factor. Growth requires investment, which in turn requires substantial amount of domestic savings. The stock market is a channel through which the savings of the investors are made available to the corporate bodies. So savings are distributed over various assets like equity shares, deposits, mutual funds, units, real estate, and bullion. The planning and investment portfolio calls for expertise and time. One should know and understand the investment opportunities available and be in a position to track them. People do not know what it takes to construct a portfolio and maximize return from it. Which stocks to buy, when to sell, bonds or fixed deposits. All this can be difficult, time consuming and confusing. Such type of portfolio should be selected that suits one risk profile, one that serves investments needs and one that spreads risk. So the investment process consists of four stages, which is investment policy, investment analysis, valuation of securities, and portfolio construction. As regards investment policy, the investor has to see that he should be able to create a fund which has an element of liquidity and quick convertibility of securities into cash, which is an element of liquidity and quick convertibility of securities into cash. So the investor should then analyze the securities available for investment and must make a comparative analysis of the type of industry and kind of security. So the primary concern of the investor at this stage is to analyze the returns and associated risk concerning the security. For the valuation of securities, investment value in general is taken to be the present worth to the owners of future benefits from investments. The last stage, that is portfolio construction, requires a knowledge of the different aspects of the securities. Traditionally, portfolio management was the selection of securities to suit the particular requirements of an investor. But the modern portfolio theory emphasizes on the maximization of returns through a combination of securities. The modern portfolio is based on a scientific approach which is based on estimates of risk and return of the portfolios and the attitude of the investors towards a risk-return trade-off through analysis and screening of individual securities. Though diversification of securities is important, but the securities have to be evaluated and thus diversified to some limited extent within which the maximum achievement can be sought by the investor. So the investor's portfolio should consist of the following: safety of principal, adequate liquidity, stability of income, capital growth, and purchasing power stability. The safety principle demands careful review of economic and industrial trends before deciding types and timing of investment. Adequate liquidity implies that the investment is a liquid asset. If it can be converted into cash without delay at full market value in any quantity. The portfolio of an investor should contain a planned proportion of the high grade and a readily sellable investment. The investor should also consider stability of monetary income and purchasing power income. Capital growth has now become an important principle. So the ideal growth stock is the right issue in the right industry, bought at the right time. Lastly, the investment must involve the commitment of current funds with the objective of receiving greater amount of future funds. For this, the investor has to study the degree of price level inflation he expects and the possibility of gain and loss in the investment. Traditionally, investment analysis is emphasized only on the projection of prices and dividends. But the modern approach is to analyze risk and return of the common stock rather than rely on price and dividend estimates. Making sound investment decisions requires both knowledge and skill. Knowledge is required regarding the complex investments, alternatives available in the economic environment, a skill required to evaluate risk and return associated with an investment. Investment includes three elements: risk, return, relationship of return and risk, and time factor. So the returns known as rewards from investment includes current income as well as capital gains or losses which arises by the increase or decrease of the security prices. So the ultimate objective of the investor is to drive a portfolio of securities that meets his preferences for risk and expected return, and the investor will select only those securities that maximizes his utility. Thus the decision involves the trade-off between risk and expected returns. So to arrive at this trade-off, the investor should decide whether his portfolio should contain only bonds or only common stock. In case it decided to have a mix, what should be the combination of the two kind of securities, that is, what part should contain stocks and what part bonds. The investments are then examined over the time period and expected risk and returns are measured. So in this case, the investor usually selects a time period and return that meets expectations of return and risk. The management of investment is thus a complex study of maximizing returns. It is done on the base of three approaches, that is fundamental analysis approach, the technical analysis, and efficient market theory. So the fundamental analysis approach is a method of finding out the future price of a stock which an investor wishes to buy. The method of forecasting the future behavior of investments and the rate of return to them is clearly through an analysis of the broad economic forces in which they operate and the analysis of the company's internal working through statements like income statement, balance sheet, and statement of changes of income. Thus, in case of fundamental analysis, the security analysis or prospective investor analysis, factors such as economic influence, industry factors, and company information, such as product demand, earnings, dividends, and management, in order to calculate an intrinsic value of the firm's securities, of firm securities. So the portfolio analysis begins where investment analysis ends. A portfolio is a combination of securities. The investor should decide how best to reach the goals with the securities available. It tries to attain maximum returns with maximum risk. A diversified portfolio is comparatively less risky than holding a single portfolio. The diversification of securities is done to reduce risk in an economy in which every asset's returns are subject to some degree of uncertainty. Most investors think that if they hold several assets, even if one goes bad, others will provide protection from an extreme loss. So there are several ways to diversify the portfolio. There is debt and equity diversification, where debt instrument provides assured return with limited capital appreciation. Common stock, on the other hand, provide income and capital gain, but they are uncertain. Both debt and equity are combined to complement each other. In a similar way, there is industry diversification. Banking industry share may provide regular return but with limited capital appreciation. So the information technology stock yield high return and capital appreciation, but their growth potential is not predictable. Similarly, security may be diversified amongst various industries like utility industry, mining industry, manufacturing group, etc. So holding one stock each from mining, utility and manufacturing group is superior than holding three mining stocks. This company diversification also where securities from different companies are purchased to reduce risk. So based on the diversification of the debt and equity industry and company, the securities are selected. A wide variety of investment avenues are open to investors to suit their needs and nature. And knowledge about the different avenues available enables the investors to choose investment accordingly. So the required level of return and the risk tolerance level decide the choice of the investor. In choosing specific investments, investors will need definite ideas regarding features which their portfolio should possess. In order to do a proper job of portfolio planning, the investor must be aware of the investment process. And the basic problem of portfolio planning is to establish an investment goal or objective and then decide how best to reach that goal. So the security is available. So by planning investment portfolio, the investor tries to obtain the maximum return with minimum risk on his investments. Thank you. Thank you very much.